You don't need a business. You don't need a six-figure salary. You don't need wealthy parents or a lucky break in the stock market. All you need is time, consistency, and the math I am about to show you. Because just a few years ago I was sitting exactly where you might be sitting right now. And I mean that literally. Back then I was genuinely terrible with money. I would get paid on Friday, and by Tuesday I had no idea where half of it went. Eating out 3 or 4 times a week. Subscriptions I forgot I even had. Random things I bought because I was bored or stressed or just not paying attention, and every single month I told myself the same exact thing. Next month I will get serious. Next month I will actually start saving. Next month became next year. And next year became 5 years of absolutely nothing saved. 5 years of working hard, showing up every single day, and having almost nothing to show for it. Then something happened that changed everything for me. A coworker of mine got laid off. No warning. No heads up. One day she was sitting at the desk right next to mine. Good job, stable income, seemed completely fine. And the next day she was just gone. And I remember sitting there afterwards thinking about her. Because I knew she had 0 savings. We had talked about it. And I thought about what that actually meant for her right now in real life. No savings, no backup, just nothing. And then one thought hit me that I could not shake for weeks. That could be me tomorrow. I had been treating my paycheck like it was guaranteed, like it was just always going to be there no matter what. And in that moment I realized it was not. None of it was. One phone call, one bad quarter at the company, one decision made in a conference room I would never be in. And everything I had built my life around could be gone overnight. So I decided I needed to figure this out. Not someday. Right then. And here is where I need to stop for a second, because I know some of you have tried this before. You went on YouTube, you read some articles, maybe you even opened a brokerage account once and stared at it for 20 minutes, and then closed it because you had absolutely no idea what you were looking at. One person told you to buy individual stocks. Someone else said crypto was the future. Another person was talking about options and puts and calls and things that sounded like a completely different language. And after an hour of that, you just closed everything and told yourself you would figure it out later. I did the exact same thing. Multiple times. Here is what I eventually figured out. A lot of people in the finance space, and whether they mean to or not, make this stuff sound way more complicated than it actually needs to be. Because complicated sounds like expertise. Complicated sounds like you need to keep watching and keep coming back for more. But for the average American who just wants to build real lasting wealth over time, the strategy fits on a napkin. It is that simple. And the fact that nobody ever handed you that napkin is honestly one of the biggest failures of our entire education system. So let me hand it to you right now. You invest $100 every single month, $3.33 a day, less than a coffee. You put that into a simple S&P 500 index fund, which is basically a basket holding the 500 biggest companies in America. Apple, Microsoft, Amazon, Google, all in one single investment. You are not betting on one company succeeding or failing. You are betting on American business as a whole continuing to grow over time. Now the S&P 500 has averaged around 10% per year over the last 70 years. Some years are up big, some years are ugly. But over the long run, 10% is what the historical data shows. That is the number we are using today. And just to be completely straight with you, past performance does not guarantee future results. But if history is any guide, and for long-term investing it is the best guide we have, 10% is a reasonable long-term expectation. So what actually happens to your $100 a month? After 2 years you have put in $2,400 of your own money. Your account shows about $2,650. That is barely $250 of growth. I know exactly how that feels. You stare at that number and think, is that seriously it? All those months of discipline for $250? And here is what I need you to understand right in this moment, because this is the exact point where most people quit. In the early years of investing, you are carrying almost all of the weight yourself. Almost everything in that account is your own contribution. The compound growth engine has not fully turned on yet. Think of it like pushing a snowball up a hill. Your hands are burning. It is heavy and slow and nothing seems to be happening. But the snowball is getting bigger with every single push. You just cannot see it yet. There will even be months where your account is worth less than what you put in, where the market drops and your balance goes down, and every instinct you have will tell you to stop, to sell, to wait until things get better. Do not listen to that instinct, because what comes next makes every single bit of it worth it. After 5 years, you have put in $6,000. Account worth around $7,700. The engine is warming up. After 10 years, you have put in $12,000 of your own money. And your account? Over $20,000. That extra $8,000? You did not earn that at your job. You did not stay late for it. You did not pick a winning stock. It appeared because your money started making money. That is compound interest finally waking up. And from this point, it only gets faster. Now here is where the real story begins. Because most finance content shows you one static number. Invest this much for this long and get this result. But real life does not work like that. Your income grows over time. Your ability to invest grows with it. And when you combine a growing contribution with compound interest over 40 years, that is exactly how ordinary Americans retire as millionaires. Let me walk you through it decade by decade. Your 20s, $100 a month. You are young, maybe entry level, maybe still dealing with student loans, maybe living paycheck to paycheck most months. $100 a month is doable. You open a Roth IRA. I will explain exactly what that is in just a moment. You set $100 on automatic investment every single month into an S&P 500 index fund. And then you do the one thing that sounds simple but is honestly harder than anything else in this entire video. You leave it alone. You do not check it every day. You do not panic when the market drops and the headlines are terrifying. You do not sell. You do not pause your contributions. You just keep going. $100 every single month. No matter what the news says. End of your 20s, 10 full years in, you have contributed $12,000. Your account is worth over $20,000. $8,000 appeared from nothing except time and consistency. The snowball is at the top of the hill. And now it is rolling completely on its own. Now you are 30, a raise or two along the way, maybe a promotion, maybe a better job somewhere. Income has gone up, so now you do one simple thing. You increase the investment. Not dramatically. Not to something that stresses your budget. You go from $100 to $300 a month. $10 a day. Probably less than most people spend eating out every single week. $300 a month all through your 30s. And that $20,000 from your 20s? It is not sitting still. It is compounding every single month. Growing while you sleep. Growing while you are at work. Growing on weekends when you are not even thinking about money. End of your 30s. Entering your 40s. Your account has grown to over $117,000. You personally contributed $56,655 of your own money across those 2 decades. The other $61,000 came from compound growth alone. Money you never worked for. Money that showed up because you stayed consistent and did not quit during those early years when nothing seemed to be happening. Now you are in your 40s. Career more settled. Income higher. You increase one more time. $300 up to $600 a month, $20 a day. Roughly what a lot of Americans are spending every single month on streaming services and subscriptions they completely forgot they signed up for. $600 a month all through your 40s. That $117,000 is compounding powerfully now. This is the part where the math starts to feel almost unreal. The snowball is enormous and picking up speed completely on its own. Entering your 50s. Your account is worth over $443,000. You personally put in around $128,000 total across 30 years. The other $315,000 came from compound growth, $315,000 that came from nothing except time, and the decision you made back in your 20s to start and not stop. Final stretch, your 50s. Retirement 10 years away. One last increase, $600 up to $800 a month. Less than $30 a day. $800 a month for 10 years. Your account sitting at $443,000, still compounding every single month in the background. And when you retire? Over $1.3 million. You personally invested $224,000 of your own money across 40 years. Your account is worth $1.3 million. The difference, over $1 million, came from compound interest. From time. From starting when you did not feel ready. From not quitting during the years when the results felt invisible. 224,000 in, 1.3 million out. That is the math that nobody taught you in school. And honestly, that nobody wanted you to know. Now I know what some of you are thinking right now. You are thinking, okay, but I am already 35. Or 40. Or 45. Is it too late for me? Here's my honest answer. No, it is not too late. But I also want to be completely real with you. Every single day you wait costs you more than just the contribution you missed. It cost you all the compound growth that contribution would have generated for the next 20 or 30 years. That invisible loss is the most expensive thing most Americans never see coming until it is too late to fix it. And I want to leave you with one number that makes all of this real. If you had invested just $100 a month, starting in January of 2009, right in the middle of the worst financial crisis in decades, when every expert on television was saying the market was finished and the economy was completely done, your account today would be worth over $400,000. The people who waited for things to feel safe again missed almost the entire recovery. They bought back in when prices were already high. They spent years trying to make back ground. They never should have lost in the first place. Waiting for the right time to invest is a plan that has never worked. Not once in history. All right, here is exactly what you do this week. 3 steps. Step 1. Open a Roth IRA today. If you earn income in the United States, you can open one right now. Fidelity. Charles Schwab. Vanguard. All completely free. All online. Takes about 10 minutes. Here is why this account matters so much. Your money grows completely tax-free inside a Roth IRA. You put in money you have already paid taxes on, and when you retire and take it out, you pay 0 taxes on the gains. 0. On potentially hundreds of thousands of dollars of growth. The government cannot touch it. And right now, less than 25% of American households are actually using one. 3 out of every 4 Americans are leaving one of the most powerful wealth-building tools ever created, sitting completely unused on the table. Step 2. Set up automatic investing inside your Roth IRA. Pick a simple low-cost S&P 500 index fund. On Fidelity, that is FXAIX. On Vanguard, that is VFIAX. If you want an ETF, VOO. Any of these work. Low fees. Diversified across 500 companies. Set your monthly amount, put it on automatic, and then leave it alone. Do not react to the news. Do not check it every single day. Just let it run. Step 3. Follow the decade plan. Start with whatever you can afford right now. $100, $50, even $25. The amount matters less than the habit right now. And every single time your income goes up, raise, promotion, new job, you increase your contribution a little. That is the whole strategy. That is genuinely all there is to it. One last thing. And this is the part I wish someone had told me years ago when I was still spending every dollar I made and telling myself next month would be different. The hardest part of building wealth is not opening the account. The hardest part is staying in when everything inside you is screaming to get out. There will be a year, probably more than one, where your account drops 20 or 30%. The news will be terrifying. People around you will be selling everything and telling you to do the same. Do not sell. Every single market crash in history has eventually recovered. Every one. The people who sold locked in their losses forever. The people who stayed, especially the ones who kept investing during the dip, came out dramatically ahead on the other side. Compound interest does not reward intelligence. It does not reward perfect timing. It rewards one thing and one thing only: patience. One final time, the complete picture. 20s, $100 a month. 30s, $300 a month. 40s, $600 a month. 50s, $800 a month. Total you personally invest, $224,000. What you retire with, over $1.3 million. Open your Roth IRA this week. Set up your first automatic investment. Start the clock today. Because the clock is the only thing in this entire equation you cannot get back once it is gone. Now, before you go, drop a comment right now and tell me 2 things. How old are you? And how much do you currently have saved for retirement? Just those 2 numbers. Because based on exactly where you are, I am going to tell you precisely how much you need to invest each month to retire a millionaire. I read every single comment, so drop your numbers below and I will get back to you personally. And hit subscribe, because next week I am breaking down exactly which S&P 500 fund to pick inside your Roth IRA, how much you should actually be investing right now based on your specific age, and the 3 mistakes that cost most beginners thousands of dollars in their very first year of investing. You do not want to miss that one. See you next week.